Okay, welcome back. In this segment, we will take a look at some more common stock characteristics, and then start to take a look at the different measurements and numerical standards and calculations that we use to measure a stock and its value, with particular attention to dividends, because dividends don't lie. Slide 62, a stock spin-off. What? Well, this is when one company divests itself of another company. It's a conversion of one of a firm's subsidiaries to a standalone company by distribution of stock in that new company to existing shareholders. Huh? What's going on? They're spinning off a company from within themselves. Sometimes the new company is still majority owned by the company that spun it off. For example, Kraft was spun off from Altria, which is the new name for the old company, Philip Morris. Believe it or not, Philip Morris owned Kraft. They also used to own Miller Brewing Company and Post Cereal and many other companies. Why? Because they had so much cash coming out of their ears, they had to do something with it, because cigarettes are very profitable. And there were many people who would never invest in a tobacco company. So Kraft, the world's at the time second largest company, second largest food company, was one company that people would never invest in because of the tobacco. So they spun it off. Kraft then broke itself into two parts. Altria then divested itself of its international tobacco business, because the international tobacco business, Philip Morris International, is the growth section of Altria, Philip Morris, whereas the tobacco industry in the United States, the market is declining. The international business is doing well because outside the world they think we all smoke cigarettes and ride horses and wear cowboy hats and smoke Marlboros. Anyway, the history of spin-offs has been checkered. Some spin-offs have done better than the companies that spun them off. For example, the Baby Bells, after they were spun off from the old AT&T in the mid-1980s, did better than AT&T, and they started swallowing one another until finally one of them got so large it turned around and bought the old AT&T. Some spin-offs have not fared so well. Coca-Cola Enterprises, which is the company that bottles the Coca-Cola. Coca-Cola makes the syrup, which is the ingredient that makes the Coke, the soda. But Coca-Cola Enterprises is the bottling company. They didn't do so well. And Lucent Technologies, which used to be Bell Labs Western Electric, which was spun off from AT&T, was a major disappointment. Not because they don't make the best telephone equipment in the world. They do. But they made some very bad investment decisions, which we'll take a look at later on. So sometimes they do well, the spin-offs, and sometimes they don't do well. Yeah, so you have to be careful. Often it's a good sign. Often when a company spins another company off, it means that they think that the company's going to do really, really well. Sometimes they're just trying to get rid of it. In the case of Target, which got rid of Mervyn's then went out of business, right? So sometimes you have to be careful. Slide 63, a stock split. Now there's a big brouhaha around stock splits. People get really excited about them. But in reality, folks, they're not much to get excited about, especially now because there's no real technological reason for them to split. There used to be a reason, because remember the 100 shares? Exactly. To help trading. But now it doesn't matter anymore. It's all electronic. A stock split is a maneuver in which a company increases the number of shares outstanding by exchanging a specified number of shares for each outstanding share. Now that sounds a little bit more complicated than it really is. You had one share, you now have two. You have 100 you had 100 shares, you now have 200 shares. That's a 2-for-1 split. Well, big deal. The price has dropped in half. Yeah, it's a 2-for-1 split. You have twice as many shares, but the price went down in half. There's no value increase. It's a psychological increase at best. And there are other splits. There's 2 for 1, 3 for 2, 3 for 1. And then there are reverse splits, 1 for 5. Yeah, you give them 5 shares, they give you back 1. That's usually when they want to increase the price because they're in trouble of being delisted from a stock market. For example, if the price goes below $1 on the NASDAQ, they don't want you anymore. So companies will say, hey, we still want to be on the NASDAQ, so we'll reverse split. We'll take 10 shares away from you, give you 1 share, and increase the price by 10. It's usually a very bad sign. As we said, there's no increased value from stock splits. If you had 1 share at $20, you now have 2 shares at $10. The value is still $20. Companies do it often now to tell the world, we're really excited about our future, but we're not going to tell you that because if we do and we don't do well, then the lawyers will sue us. Warren Buffett of Berkshire Hathaway fame has refused to split its stock since its inception. A single share now goes for over $245,000 as of this time. What? Well, that's exactly what happened to companies like Coca-Cola and GE. If they had never split the stock, one stock would be worth hundreds of thousands of dollars. It's also a testament to how well Mr. Buffett has done as an investor. Berkshire Hathaway is the company he uses to buy other companies, and he's done very, very well for himself. But who's going to buy 1 share of Berkshire Hathaway? Not too many people. More about that later. Slide 64. Treasury stock. What? Well, these are shares of stocks that have been sold and then subsequently repurchased by the issuing firm. It goes by various names. Share buybacks. That stock is now been retired. It's placed in the Treasury. So the share buybacks reduce the number of shares outstanding. The logic being that after the buyback, there is less supply of outstanding stock. Existing shareholders now have a larger percentage ownership of the corporation. And you economics majors, or you've taken econ, if you decrease the supply, assuming the demand stays the same, what should happen? Right, the price should go up. Now, it's not a guarantee, but that's how economics works often. You decrease the supply. If the demand doesn't change, then the price should go up. During the run-up of the 1990s, share buybacks were often seen as a better alternative to dividend increases. The belief was that investors were more interested in capital gains than dividends, and that buybacks increased the potential for capital gains by reducing the supply of stock. Well, it doesn't always work that way. It is very similar to when you or I buy a share of stock or shares of stock. The company should be buying them when the price is low, not when the price is high, just to boost the price higher, in my humble opinion, and others, where others say, no. Pump up that share price. I want capital gains. I'm going to be gone anyway. I'm only renting the stock. I'm not an owner. You decide, dear students. Slide 65. Classifications of common stock. See, once a company gets large enough, they will start issuing, for various reasons, different classes of stocks. Similar, but very, very different than the mutual fund shares, which are basically all the same. The only difference is how they're being charged. In the case of common stock, sometimes one classification has voting rights and the other one doesn't, or one classification pays better dividends. Yes, often the family gets the ones that pay very good dividends, or maybe they keep the ones that have stronger voting rights. So you have to be careful about what shares you're buying. In the case of Google, they have a second share class which has more power, has more voting rights than the typical class that you and I buy. I think Facebook did that too. The example we'll take a look at is Berkshire Hathaway. Remember the Class A shares? They're the original shares. They're the ones that are selling for over $245,000. Well, in the mid-90s, the financial world pressed Warren Buffett to offer a lower-cost version of his stock. He didn't want to do it. In fact, in the prospectus, he said, I would not buy these shares. So he came up with a Class B shares. And just to he didn't make them $100 or $50. They were priced at over $1,000. He's a bit of a curmudgeon, ornery guy. And if you don't know what curmudgeon means, look it up. It's another fancy word for somebody who is contrary. Well, after a while, he realized that these things were actually very useful because he could use them to buy other companies. So in 2013, he split them 50 for 1. You had 1 share of Class B stocks. You now had 50, which lowered the price and made it easier for him to use them as cash or use them to buy other companies. And now the Class B shares, as of this time, are selling for about $160. Burke B. Burke A are the really expensive ones, and Burke B are the cheaper versions. Make sense? I think GM at one time had about 7 or 8 classifications. They had up to H or something, I think, as I remember. That was back in the 80s. Slide number 66. A few other values that are important, and we'll take a look at. Well, actually, we'll only look at par value today, and that's it. No more. I don't really understand how this works, but on the certificate, the stock certificate, which nobody gets anymore, you'll see this par value, which is sometimes $1, sometimes it's a penny. I don't really understand what it means. I think maybe I knew a million years ago and I don't now, but nobody uses it. Book value is more important. Book value is the value of a shareholder's equity minus the firm's liability and preferred stock. In other words, what a shareholder owns in the firm. And that is something that you don't see posted often. Sometimes you see it. You have to dig down into the key statistics of a website usually, and fewer websites are actually showing it. You have to go to the company itself to find the book value. And this is what would happen if you were to sell off all the assets, pay off all the debts. What would you have left over? And what we'll find is that the book value is normally much less than the market value, the prevailing price of the security. And this makes perfect sense when you think about it. Why? Because, think about it, dear students, a pizza shop, what's it really worth? Yeah, what's it worth if you were to liquidate all the assets, pay off all the debts? No, a company is worth a great deal of money because of the business that it's in and the income it's generating. So traditionally, the book value will be less than the market value, sometimes a whole lot less, depending on what type of company it is. And this makes sense. What happens when the book value becomes greater than the market value? Well, that usually means the company is in serious trouble and investors are fleeing. They're selling the shares. And what happens sometimes, depending on the situation, is that these people who are called sometimes private equity artists or takeover artists or corporate raiders, they will swoop in and buy 50% plus 1 of the stock, which means they now control the company. They'll liquidate it and pay off all the assets, and hopefully they walk away with money in their pocket, at least from their point of view. Why would you want to liquidate a company if you were the if you were the employees? You wouldn't, right? But you're not in charge. You don't own the shares of stock, and so the employees they cry out to their elected representatives and say, "This is horrible," and the community gets upset because now the company's out of business, and the economists and the private equity artists, if they would deem to talk with you, would say, "You don't understand. The capital of that company, the resources of that company were locked up and were being unproductive. We need that company to be plowed under. We need that capital to be released and brought forth into the economy to be better utilized. And the people who were working those jobs, that was human capital that was being wasted." Well, when you're out of a job, you know, it's very nice to hear all this, but hey, I got to put food on the table. And dear students, this is why we have unemployment insurance. This is why, as some politicians scream and holler, we pay people not to work. No, we're not paying them not to work. We want that capital to be unlocked. We want that company to be tilled into the soil, so to speak. If you think of it like a farmer, because we want an efficient economy. And so, while those individuals are finding a new job, we want them to have food on the table. That's the reason. We're not paying people not to work. Politics, folks. Poly means many, and ticks are blood-sucking insects. Okay, slide number 67. Dividends. Okay, let's spend some time on dividends because dividends are very cool. These are shares of earnings given to stockholders, normally paid quarterly. Now, in the United States and other countries that had something to do in the past with the United Kingdom, stocks normally pay quarterly dividends. Once you leave those companies, now we're talking the UK itself, Canada, Australia, Hong Kong, South Africa. I'm sorry, South Africa. These are countries that had something to do in the past with the UK, and so they pay quarterly. Other companies outside those areas, Europe, Japan, will pay every 6 months or sometimes once a year. Right. So that's a bit of trivia that you should remember. Just remember that United States companies pay typically quarterly. The board of directors decides how much, if any, dividends should be paid and when to pay them. Now remember, dividends are optional. They don't have to pay them. They can stop at any time, but companies such as GE and Johnson & Johnson have been paying dividends for decades. The dividends are usually a percentage of the earnings per share. Earnings per share is a very important number. The amount of annual earnings available to common stockholders as stated on a per share basis. In other words, how much is my one share earning? Okay? So let's take a look at the example on 68. A company reports net profits of $1 million. Yippee! That's a lot of, well, depends on how many shares there are. To you and me, that's a lot of money, but how many shares are outstanding? In this case, there are 500,000 shares outstanding. So you take 1 million divided by 500,000 and just cross off all the zeros, and you wind up with $2 per share. And then the board of directors might decide to pay out 50% of the earnings per share in the form of dividends. Therefore, each shareholder would receive $1 dividend for each share they owned. Does that make sense? That's called the dividend payout ratio. They're earning $2 per share. They pay out $1 per share. They're paying out 50% of their earnings to shareholders in the form of dividends. Cool. Okay. Now, the dividend yield is actually a more important number. Slide 69. This is the measure that relates the dividends to the share price and puts the stock dividends on a relative percentage basis rather than an absolute dollar basis. So if the stock in the previous slide that was paying $1 dividend were selling for, say, $20, then we'd take $1 divided by $20 and get 0.05 or 5%. Now, this makes it easier to compare our stock with other income-oriented vehicles such as bonds or savings accounts. And we said traditionally 3 to 6% was normal. In the 1990s, dividends went to 2% until the peak in March of 2000, they hit 1%. Dividends went above 3% in the 2000 to 2008 to 2009 turmoil because the prices went down. And now they're back down, to approximately 2% or so. So dividends in the S&P 500 as a whole. But some companies aren't paying any dividends and some are paying much more generous dividends. So you have to look at individual companies, and I'm going to ask you to do that. I'm going to ask you to research several companies. You'll find some don't pay any dividends, and others pay, not bad. Others pay pretty darn good. So, some important dates for stocks, dividends. Slide 70. The declaration date. This is the day that they declare the dividend. So they say, you know what, we're going to pay $1 dividend. But they don't pay it that day. They give investors time to either sell their shares if they don't want the dividend or buy the shares. And that's the date of record. That's the date on which an investor must be a registered shareholder of the firm to be entitled to receive the dividend. Now, here's where it gets a little tricky. The ex-dividend date is 3 days before the date of record. That actually determines whether one is an official shareholder of the firm and thus eligible to receive a declared dividend. Huh? What? Relax, relax. You have to buy the shares 3 days or more before the date of record. Why is that? Well, hang on. We'll take a look at the next slide. And then the payment date is several weeks later. That's the day you actually get the dividends. And they don't send you a check anymore. That's all electronic. So let's discover why we have to buy the shares 3 days. Why is the ex-dividend date 3 days before the date of record? Slide 71. Well, it has to do with how stock transactions close. Stock transactions close in 3 days. Mutual fund transactions close in 1 day. If you purchase a stock on June 15th, you actually don't get the stock until June 18th, assuming it doesn't span a weekend. Theoretically, the opening share price on the ex-dividend date should reflect a drop in price commensurate with the amount of the dividend. Huh? In other words, if there's a $1 per share dividend, the opening stock price on that ex-dividend day should be reduced by $1 because they're pulling $1 out of, for every share they're paying, the shareholders are paying $1. So the share price should fall that day. Well, folks, it never works that way in the marketplace since prices are changing all the time. And so what does that mean? On slide 72, you will hear a saying in the industry, don't buy the dividend. And what's the translation? Well, you're better off waiting until the ex-dividend date before buying the stock. Here's the logic. Dividends are taxable transactions. If you buy the dividend, in other words, you buy the stock just before the ex-dividend date, you will be responsible for paying the tax. And presumably, the stock price will fall commensurate with the amount of the dividend. So you are better off waiting until after the ex-dividend date so that you will be able to get the stock at a better price and not generate a taxable transaction. Read that again if it doesn't make sense. I mean, you're saying don't buy the dividend. Wait until after you get the dividend. Now, for individual stock purchases, I mean, as long as you're not buying 100,000 shares, it's not a big deal for you and me, individual retail investors. There's something to be said about this if you are going to make a large purchase, especially if it were a mutual fund. Exactly, because many people will, at the end of the mutual funds normally make their distributions of capital gains and dividends at the end of the year, in December sometimes November, December. So at the end of the year, if you are going to make a large purchase of a mutual fund, or a stock for that matter, check the stock, individual stock, check to make sure your mutual fund's not ready to make a huge distribution. But again, most of us, it's not going to be a big deal. We're buying them $500 at a time if we're buying stocks, $100 if we're buying mutual funds. It's not that big a deal. Slide 73. So I say, forget about it. But this is a big deal on slide 73. Because there are basically two types of dividends: cash dividends and stock dividends. If you don't understand the next slide and a half, then just remember that you want cash dividends. You want a cash dividend. You don't want a stock dividend. Well, what's the difference? Well, the cash dividend is a payment of a dividend in the form of cash. It is a taxable transaction. That's what we want. We want the money in our pocket. Whereas a stock dividend is a payment of a dividend in the form of additional shares of stock. This is like a stock split. All else being equal, stock dividends have no value because they constitute a dilution of ownership. They are issuing more shares. And you Students of econ, right? If the supply goes up and the dividend, the dividend, the demand does not change, the price will go down. The board of directors declares a 10% stock dividend. So for every 10 shares, you receive an extra share. Whoopee! Correspondingly, the price of the shares dropped 10%. So they're not giving you anything. But thank you very much, IRS. Unlike a cash dividend, a stock dividend is not taxed. Big deal! It's not worth anything. Thank you very much, IRS, for not taxing me on something that's not worth anything. So which one do you want? Do you want cash dividends or do you want stock dividends? You want cash dividends. Right. Now, here's where it gets a little tricky. Slide 74. A dividend reinvestment plan is sometimes called a DRIP. Isn't that a great name? A DRIP. It's a plan in which shareholders have cash dividends automatically reinvested into additional shares of the firm's common stock. This is how mutual funds work. Yes, it is a taxable transaction, but they're not giving you cash. They are giving you more shares. There is no additional shares issued. The company actually goes out and buys their own shares on the open market and gives them to you. Now, this is how mutual funds work. And normally it's very, very cool. I think you decide. But if you don't need the cash, just as we discussed that when we looked at mutual funds, if you don't need the cash, it's almost always the best idea to have them reinvested in additional shares, whether it's a mutual fund or it's a stock. And the cool things about dividend reinvestment plans is you're not generating any brokerage fees. Yes. DRIPs are an excellent way to own stock for those interested in long-term growth and don't need or not interested in current income. It allows the investor to take advantage of compounding automatically with normally no or very small transaction costs. Investing in a company like General Electric or Johnson & Johnson in this way is almost like investing in a mutual fund because these companies are so large and well diversified. On the website and in Canvas, there is an example of a DRIP through San Diego Gas and Electric. Indeed, and you often go directly to now your brokerage firm will normally do this for you too if you ask them to. But if you go directly to GE or Johnson & Johnson or SDG&E and look for the link, go to their website, look for the link that says Investors, Investor Relations. Often these big firms will have dividend reinvestment plans. Now, they don't run them. Some company runs them on their behalf. But every once in a while, we had one through SDG&E. We'd get 9 cents. A 9-cent charge. Because that's how much it cost them to run the darn thing. It cost them, pennies. And very cool. And you see your number of shares going up as it reinvests the amount into more shares. Now, it's still taxable. You have to, you're going to get a 1099. You're right. And and at first, it's not going to be a lot of money. The taxes are going to be very, very little. And once they are large, congratulations, dear students. You're doing okay. Okay, so go back and make sure you understand all this stuff about dividends, because dividends don't lie. Our last measurement, price to earnings ratio. Oh boy, folks. This is arguably the most important stock market statistic. It's certainly the one that they watch the most. PE, it's sometimes written as P/E, sometimes it's just PE. The price of the stock divided by the earnings per share. It's a very simple calculation, and you don't have to do it. You just look it up. But you take that $20 price of that stock that we were looking at, that example stock. You divide it by its $2 earnings, and you get 10. Now, don't put a dollar sign, don't put a percent sign. It's not a percentage. It's a unitless number. But it's a very important number. And we'll discuss what it means in more detail, but very simply, it's a measurement of how optimistic or pessimistic investors are about the future for a stock. Typically, they were in the 5 to 14 range. Now, 15, 16 is normal. 20 or above was considered unusual. but not anymore. There are many companies that have PEs in the 20, and some PEs are astronomic. They're way in the sky. We will spend a great deal of time learning about PE and other valuation techniques in the next few chapters. So now I want you to go back and review this and look at stock worksheet number 2. So go through and do stock worksheet number 2. The answer key, the commentary is online on the Canvas and the website. So check them out and review this material. Woo! How are you getting an education? I sure hope so. Dear students, we are asking always for your feedback. We want to know how this is going for you. How do you like Canvas? How do you like the materials in Canvas and on the website if you're using the website or just linking to it? Are the presentations helping? Because as we've said, we want this to be the best college class you've ever taken. And for that to be true, we need feedback. We want to know what's working. We want to know what's not working. And we want you to be awesome. And we want you to be rich, too. So study hard. Bring honor and glory to Southwestern College. And we'll see you in our final presentation. Whew! This is a killer chapter. For chapter 5, Introduction to Stocks, where we'll take a look at the different type of stocks and stock investing strategies. See ya!